EPK Capital presents Deep Dive on ONGC. Hello everyone. Welcome to EPK Capital's Deep Dive video. In this series, we analyze one company each day based on the security analysis by Benjamin Graham. Today, we are going to talk about ONGC. For over 6 decades, one company has been the bedrock of India's energy security, discovering the oil and gas that fuels the nation's growth. That company is Oil and Natural Gas Corporation, or ONGC. But in a world rapidly shifting towards new energy sources, is this Maharatna a relic of the past, or a giant poised for transformation?
The business of ONGC from exploration to end product.
To understand ONGC as an investment, we first need to understand its massive and multifaceted business. At its core, ONGC is India's largest exploration and production, or E&P company. Its primary job is to find and extract crude oil and natural gas from the ground. Its dominance is staggering. ONGC contributes around 71% to 75% of India's domestic crude oil production and about 84% of its natural gas production. This critical role has earned it the title of a Maharatna company, a status reserved for the largest and most profitable public sector undertakings in India. But ONGC doesn't just pull resources out of the ground. It operates across the entire hydrocarbon value chain, a strategy known as vertical integration. This became especially true after its 2018 acquisition of a majority stake in Hindustan Petroleum Corporation Limited, HPCL, a major fuel retailer. Along with its other subsidiary, Mangalore Refinery and Petrochemicals Limited, MRPL, ONGC now has a formidable presence in the downstream sector, that is, refining crude oil into products like petrol, diesel, and LPG. This integration creates a powerful natural hedge against the volatility of oil prices. When global crude prices are low, the profitability of its core exploration business suffers. However, its refining subsidiaries benefit from cheaper raw material costs, which can cushion the overall financial impact. Conversely, when crude prices are high, the exploration business thrives. This structure provides a degree of stability that a pure E&P company wouldn't have, though it also introduces the complexities and debt associated with managing such a vast integrated operation. ONGC's reach extends far beyond India's borders through its wholly owned international arm, ONGC Videsh Limited, or OVL. OVL's mission is to acquire and develop oil and gas assets around the world with a presence in 15 to 19 countries, including Russia, Vietnam, Brazil, and parts of the Middle East and Africa. These international projects are crucial for bolstering India's long-term energy security. However, this global footprint is not without risk. Operating in politically sensitive regions exposes OVL to challenges like international sanctions, civil unrest, and diplomatic tensions, adding a layer of geopolitical volatility to its performance. Recognizing the global shift in energy, ONGC is strategically diversifying its portfolio. It has a significant presence in the petrochemicals sector through its subsidiary, ONGC Petro Additions Limited, OPAL. More importantly, it is making a concerted push into renewable energy. Through partnerships with companies like NTPC, ONGC is investing in wind and solar power projects, aligning itself with India's ambitious clean energy goals for 2030. This pivot indicates that the company's leadership is looking beyond its traditional hydrocarbon business toward a more sustainable future.
Governance and ownership, the hand of the state.
ONGC is a public sector undertaking, and its ownership structure reflects this. The promoter of the company is the President of India, meaning the Government of India, which holds a consistent and commanding stake of 58.89%. The rest of the shareholding is distributed among major institutions and the public. As of recent data, foreign institutional investors, FIIs, hold about 7.1%, while domestic institutional investors, DIIs, hold a significant 19.85%. This DII holding is dominated by giants like the Life Insurance Corporation of India, LIC, which holds over 9%, and various mutual fund schemes. Retail investors like you and me collectively own about 14.2% of the company. The company is led by its chairman and CEO, Mr. Arun Kumar Singh. But the board also includes government nominee directors, ensuring that the company's strategies remain aligned with national policy. This high government ownership is a defining characteristic of ONGC as an investment. It means that the company's decisions are not always driven by the sole objective of maximizing shareholder profit. At times, ONGC is called upon to serve broader national interests, such as sharing the fuel subsidy burden to keep consumer prices stable or facing windfall taxes when oil prices are high. This often results in what the market calls a PSU discount, where the stock trades at a lower valuation compared to its private sector peers, despite its enormous size and market leadership. To truly understand ONGC's performance, we need to look beyond a single year and analyze its journey over a full business cycle. Here is a look at its consolidated financial performance over the last 10 fiscal years. As the table clearly shows, ONGC's revenue is on a roller coaster, directly tied to the cyclical nature of global crude oil prices. The troughs in fiscal years 2016 and 2021 correspond to periods of low oil prices, while the peaks in 2019 and 2022 to 23 reflect periods of price recovery and strength. The significant jump in revenue from 2019 onwards is also amplified by the consolidation of HPCL's massive revenues into ONGC's books. However, a crucial observation is that net profit doesn't always follow revenue in lockstep. Look at fiscal year 2023. Revenue surged to a record high of over 6 lakh crore, yet net profit actually fell significantly from the previous year. This disconnect is a direct consequence of government policy. During periods of very high oil prices, the government often imposes windfall profit taxes, which directly reduces the company's bottom line. This mechanism effectively creates a ceiling on ONGC's profitability, preventing investors from realizing the full upside of a commodity boom. The debt-to-equity ratio provides insight into the company's financial leverage. After the HPCL acquisition and the challenging market conditions of the pandemic, the ratio rose to 0.4 in fiscal years 2020 and 2021. However, the company has shown commendable discipline since then, using strong cash flows from the subsequent oil price recovery to pay down debt and bring the ratio back to a very healthy 0.2 by fiscal year 2024. For a capital-intensive industry, maintaining a debt-to-equity ratio consistently below 0.5 is a sign of robust financial management and provides a cushion against industry downturns.
The Benjamin Graham valuation, a defensive investor's perspective.
Now, let's apply a timeless valuation method pioneered by Benjamin Graham, the father of value investing. His framework is designed to identify financially sound companies trading at a fair price, suitable for a low-risk, defensive investor. Let's see how ONGC stacks up against his 7 key criteria. 1. Adequate size. Graham required a large enterprise. With annual sales far exceeding 5 lakh crore, ONGC easily passes this test. Pass. 2. Strong financial condition. This is a 2-part test. The current ratio, which is current assets divided by current liabilities, should be at least 2. ONGC's ratio is around 0.9. Fail. Long-term debt should not exceed net current assets, working capital. ONGC's current liabilities are greater than its current assets, meaning it has negative working capital. Therefore, it fails this test as well. Fail. 3. Earnings stability. The company must have had positive earnings for each of the past 10 years. As our financial table shows, ONGC has been consistently profitable. Pass. 4. Dividend record. Graham looked for uninterrupted dividend payments for at least the last 20 years. ONGC has a long and reliable track record of rewarding its shareholders. Pass. 5. Earnings growth. A minimum 1/3 increase in earnings per share over the last 10 years. A comparison of ONGC's 3-year average EPS from a decade ago to the last 3 years shows significant growth. Pass. 6. Moderate P/E ratio. The stock's price should not be more than 15 times its average earnings over the past 3 years. ONGC's trailing 12-month P/E ratio is around 8.3, well within this limit. Pass. 7. Moderate P/B ratio. The price should not be more than 1.5 times its book value. ONGC's price-to-book ratio is approximately 0.87, comfortably passing this test. Pass. ONGC passes 5 out of the 7 criteria. It is a large, consistently profitable company that pays dividends and trades at very reasonable valuation multiples. However, it fails the stringent liquidity tests related to its short-term financial position. This is not uncommon for large, capital-intensive industrial companies, but it highlights a point of caution for a truly conservative investor. The Graham number. Graham also provided a formula to calculate a stock's intrinsic value. Comparing this calculated intrinsic value of Rs 420 to the current market price of around Rs 238, the Graham number suggests that the stock is significantly undervalued, with a potential upside of over 75%.
A balanced investment thesis, pros versus cons.
Let's synthesize our findings into a balanced view of the potential investment thesis for ONGC. Dominant market position. ONGC has a near monopoly in India's upstream oil and gas sector, providing a deep competitive moat. Attractive dividend. Yield. With a dividend yield consistently above 5%, the stock is a compelling option for investors seeking regular income. Low valuation. The stock trades at a low price-to-earnings ratio of around 8.3 and below its book value, suggesting it is cheap on conventional metrics. Government backing. As a strategically vital PSU, ONGC enjoys implicit sovereign support, which virtually eliminates the risk of bankruptcy. Future growth triggers. The company is reversing its production decline with new fields coming online and is making a strategic pivot towards high-growth areas like renewable energy and petrochemicals. Commodity price volatility. The company's financial performance is highly dependent on unpredictable global crude oil prices. A sharp fall in prices would directly impact its revenues and profits. Sluggish growth and production challenges. Historically, the company has shown poor sales growth, and it faces an ongoing challenge to offset the natural decline in production from its aging fields. Regulatory and policy risks. Government interventions, such as the imposition of windfall taxes or mandates to share subsidy burdens, can cap the company's profitability and make its earnings less predictable. PSU inefficiencies. As a government-owned entity, ONGC can be subject to slower, more bureaucratic decision-making processes compared to its private sector counterparts. Execution risk and diversification. The move into renewables is a capital-intensive shift into a highly competitive sector with different dynamics and potentially lower profit margins than its core business.
Important checks for every investor.
Before concluding, let's run through a few final due diligence checks. Promoter pledging. The promoter, the Government of India, has 0% of its shares pledged. This is a strong sign of financial health and stability at the promoter level. Dividend payout. The company has a long and consistent history of paying dividends, reinforcing its reputation as a reliable income stock. Controversies and ESG risks. Reliance Gas. Dispute. ONGC has been in a long-running legal dispute with Reliance Industries, accusing it of siphoning gas from an adjacent block. While an arbitration tribunal ruled against ONGC's claim, the government is appealing the decision, creating some legal uncertainty. South Sudan operations. A more significant red flag comes from its international operations. Norway's massive sovereign wealth fund excluded ONGC from its portfolio due to concerns about its joint venture's activities in South Sudan. The fund's ethics council cited the use of security forces linked to serious human rights abuses to protect oil facilities in the war-torn region. This is a major environmental, social, and governance (ESG) risk that socially conscious investors must consider.
Conclusion and future outlook.
So what is the final verdict on ONGC? The analysis presents a classic value investing dilemma. On one hand, we have a state-backed, dominant market leader trading at what appears to be a significant discount to its intrinsic value, all while offering a high and consistent dividend yield. On the other hand, we have a company facing structural headwinds from aging oil fields, whose profits are periodically capped by government policy, and which carries notable legal and ESG risks. The investment thesis for ONGC hinges on whether its future growth, from new hydrocarbon discoveries and its strategic push into green energy, can successfully outweigh the inherent volatility and risks of its core business. The Indian government's push for Atmanirbhar Bharat, or self-reliance in energy, involves both deep water exploration and ONGC strength and a massive expansion in renewables, a key part of ONGC's diversification strategy. Ultimately, the decision to invest in ONGC is a bet on its ability to execute this complex transition. The low valuation provides a substantial margin of safety, but the road ahead is paved with both opportunity and significant risk. And that's all we had for this video. We hope this video was informative for you. If you think it was, then please do like and share this video. Also, do not forget to subscribe to our channel for such wonderful daily content. You can also follow us on Instagram and Twitter. The details are in the description. For more information, or for your personal financial advice, kindly connect with us on the details given in description. I will see you in the next video. Thanks for watching.